Welcome to the Deep Dive. Our mission, as always, is to take a stack of global intelligence, and for today, we're looking at a crucial snapshot from November 19th, 2025, and really pull out the essential intelligence you need. We're going deep into economic instability, some emerging security threats, and maybe most importantly, the surprising ways these huge global forces can impact, local businesses, maybe even the services you rely on every day. But before we jump in, I want to acknowledge the support that makes this kind of deep analysis possible. This deep dive is proudly brought to you by ProCare Hanoi. They're the phone and laptop repair shop trusted by the expat community. Fast service, clear communication, honest advice, basically everything you need when your tech starts to sweat. And to you, our listener, this is really a labor of love. So if you found value in any of our deep dives, I'd love your support. Buy me a coffee is just the simplest way to say thanks. And trust me, every single cup keeps the research going. Just scan the QR code in the podcast cover art. And for those who've already supported us, a huge, huge thanks. You are truly fueling this journey.
So today's sources, they reveal a really striking pattern. You've got risks that are converging, and they're coming from financial markets and geopolitical flashpoints at the same time. We've sort of structured this into three core movements. First, we'll look at the pretty significant market volatility. This is driven by some fundamental questions about growth and monetary policy. Second, we're going to connect two seemingly unrelated geopolitical escalations that are really raising the global risk temperature. And finally, we'll synthesize what this whole toxic mix of uncertainty means for business resilience, for supply chains, and for that crucial local demand for just reliability.
Okay, let's start there. On the economic front, our sources are indicating that global markets they've taken a pretty serious hit. And we're not just talking about a routine correction here. This feels more structural. Major U.S. indexes are sliding, and the intelligence suggests that some technical trends are. They're signaling a definitive reversal. The NASDAQ composite in particular, the one dominated by all the tech heavyweights, has dropped a worrying 6% from its recent peak.
Yeah, and that tells you something, right?
It tells us that enthusiasm is just draining out of the system, and very, very quickly.
That 6% NASDAQ drop is so crucial because, that high-flying tech sector, it was supposed to be kind of immune to normal market gravity. Our sources point to two main forces driving this sudden anxiety. The first, and it's the most visible one, is a growing skepticism around the true long-term sustainability of the AI sector.
But hold on a second. Isn't the AI sector fundamentally different from, say, previous tech bubbles? I mean, we've seen these companies generate real transformative revenues. What are the sources saying that suggests this isn't just a dip, but a real structural concern?
That's a great question. The concern, according to the intelligence, isn't about the technology itself, not at all. It's about the speed and the scale of the promised revenue compared to the current valuation. I mean, the market has priced in continuous, aggressive, just exponential growth forever.
An impossible standard.
Exactly. So when a company, even a giant in AI, just slightly misses its numbers, or even suggests that scaling up might be slower or more expensive than they thought, the correction is brutal. It's a reality check.
So people are asking, is this genuine, profitable growth? Or is it still just a sector running on hype?
Precisely. And the drop suggests investors are now demanding proof of sustainable profitability, and that just hammers valuations.
Okay, so that's one massive tremor. The foundation of tech enthusiasm is shaking.
Yeah.
What's the second factor driving all this volatility?
The second factor is the shadow of the Federal Reserve and interest rates. This affects the entire economy, not just tech.
Right.
For months, the market has been anticipating and pricing in these significant interest rate cuts. They expected them to start pretty soon to kind of ease monetary policy.
Which means the cost of borrowing money would drop, and that would fuel more investment.
Precisely. But the moment that expectation starts to wobble, say if inflation data proves stickier than they hope, or if the Fed signals they're going to hold rates higher for longer,
then the whole calculus changes.
It fundamentally resets the entire financial landscape. Higher rates mean a higher cost of capital for every single business, making investment and expansion more expensive. It just pulls liquidity out of the system. It forces companies to be much more conservative with their spending and, crucially, with hiring. The uncertainty around the Fed's next move is acting like a heavy anchor on market optimism right now.
Wow. So you combine these fundamental questions about the future growth engine AI with this basic uncertainty about the cost of doing business interest rates. And, well, you get widespread panic. But let's follow that trail down to, the kitchen table. When financial anxiety hits like this, what's the immediate practical implication for how people spend their money?
The shift is immediate and very predictable. Consumer confidence shrinks in discretionary spending. It just goes into lockdown.
Makes sense.
When people are worried about layoffs or high interest rates on their credit cards, they protect their cash. They stop investing in big-ticket items that feel like an upgrade. The market intelligence confirms a definite shift from upgrade and replace behavior to maintain and extend.
So they decide to stretch that 3-year-old laptop out to 5 years instead.
Exactly.
Yeah.
Instead of buying the newest phone for just a marginal improvement, they look for ways to keep their existing, perfectly functional devices running. And this is where the service economy, especially local tech repair and maintenance, its whole economic position just fundamentally changes.
How so?
It moves from being an optional luxury to being an essential service. It becomes an economic shock absorber for the consumer.
That economic anxiety is one thing, but what happens when you overlay genuine physical security risk on top of that? The sources are showing we're dealing with, two unrelated but pretty significant security escalations happening at the same time.
That's the really complex layer we have to unpack now.
Yes. Let's look first at the, let's call it the conventional geopolitical risk. Flashpoint 1, it's centered in the Middle East. Our sources detail the tragedy of an Israeli airstrike on a refugee camp in southern Lebanon. It resulted in 11 fatalities and many wounded.
Which is an immediate, devastating escalation in a region that's already incredibly stressed. Beyond the obvious human toll, what's the instant consequence for something like the global supply chain?
The consequence is immediate and measurable. Increased cost and delay. Sudden, tragic incidents like this instantly elevate the geopolitical risk calculation for shipping, for insurance, for trade flows through the entire Mediterranean and Suez region.
So shipping companies have to react immediately.
Instantly. Major shipping firms are forced to reevaluate their routes, which can lead to delays or diversions. Maritime insurance premiums for any vessel operating near that area, they spike immediately. This is the cost of physical risk being injected directly into the logistics pathway. So if you're a business waiting for, specialized screens or batteries that have to pass through that part of the world,
You can expect higher costs and longer, less reliable lead times, period.
okay, so physical conflict equals physical logistics disruption. That's clear. Now, Flashpoint 2. This couldn't be more different. We're talking about domestic, institutional instability right here in the U.S. It's revolving around a major broadcaster facing license threats because of ties between key network figures and the Jeffrey Epstein scandal. How does a regulatory and media risk even compare to an airstrike in terms of affecting supply chains?
It's a great question because it's a different kind of risk. This is a challenge to institutional stability. And its impact is felt in investor confidence and the flow of capital, which is just as vital as the flow of ships. When a major domestic information source faces such profound legal, regulatory, and ethical threats, especially ones tied to a scandal that really speaks to a failure of high-level accountability, it just creates a pervasive sense of institutional chaos.
You're saying it makes the whole world feel fundamentally less predictable, even for an investor looking at Wall Street.
Precisely. If the foundational institutions of a major economy like media integrity or regulatory oversight, if they appear compromised, international investors get nervous, they pull their capital back, or they demand a higher risk premium to invest in that market.
And when capital gets wary.
When it gets wary or expensive, it affects everything. From corporate financing for huge global shipping contracts, right down to the budgets available for managing these complex logistics networks. So it's this confluence of risks, physical disruption in the Middle East, and this financial and institutional uncertainty in the West that drives up the overall operating cost for the entire global tech ecosystem.
It's a fascinating and frankly a worrying duality. You have physical danger demanding higher insurance costs on one hand, and institutional chaos demanding higher capital costs on the other. But the net effect is the same.
The same. The price of getting components from point A to point B goes up dramatically.
Okay, so we've laid out the financial stress, the AI correction, the Fed anxiety, and these dual security risks. So what does this convergence really mean for you, the listener, or for any business that relies on global parts but serves a local, stressed out customer base? Let's drill down into the key signals.
Right. The first key signal, as we sort of anticipated, is the acceleration of this tech and market shakeout. I think we just have to accept that if tech valuations correct further, device upgrades are going to stall. Consumers simply won't have the financial or psychological bandwidth to participate in those expensive, planned obsolescence models. The consequence is clear. Demand for maintenance, for diagnostics, for component repair, it holds strong, and it likely increases.
Let's define that for a business owner. When we say repair becomes counter-cyclical, what does that actually look like when the economy is contracting?
It means that repair services become non-discretionary spending when essential tech breaks. If the S&P drops, people start buying new cars. But if their laptop dies, they still need it for work, right? Or for school. They're forced to repair it.
The purchase decision completely flips.
Completely. It pivots from, which new model should I buy, to, who can fix this reliably and quickly? The market becomes less about competing on novelty and much more about competing on dependability. Signal 2, then, is an urgent need to address supply chain volatility. Given the security incidents we've talked about, businesses just cannot afford a single point of failure in their sourcing. Conflict, instability. It means parts might not only be delayed, but the cost to get them might suddenly make a repair, quote, totally unviable for the customer.
Yeah, we've all felt that pain, right? Trying to source some tiny crucial component only to find out it's stuck on a container ship somewhere, or worse, the cost has tripled overnight.
Exactly. So businesses have to audit their parts lists. They have to understand their geopolitical exposure. Are you reliant on components made in or shipped through high-risk zones? Risk mitigation now means diversifying your suppliers. It means accepting slightly higher inventory costs just to ensure you have that lead time stability.
And that leads right into Signal 3, which is all about the customer experience in these uncertain times. I mean, if the whole global system feels shaky, people gravitate toward predictable local anchors. Service reliability becomes the ultimate premium. Customers do not want to layer a service headache on top of all this global anxiety. They're looking for clear communication, guaranteed lead times, and just honest advice. And this is where a business like ProCare Hanoi, our sponsor, really gains a critical market advantage. It's not just about fixing the hardware, it's about restoring trust and predictability to the customer's day.
That pivot you mentioned is absolutely essential. The customer knows the world is unpredictable. They're making a maintenance decision to reduce risk in their own life. If the repair shop can't communicate clearly about sourcing delays or turnaround times, it just makes the customer's anxiety worse.
It compounds the problem.
It does. Dependability in delivery and clarity in communication. Those are the differentiators that allow a business to capitalize on this global uncertainty.
That perfectly synthesizes the takeaways. We've seen global markets reeling from this fundamental uncertainty around AI's future strength and the Fed's next move. At the same time, security risks are flashing red everywhere, from conflict in the Middle East creating physical supply chain headaches to these deep institutional questions at home affecting investor confidence. And crucially, we see how all these combined volatile factors create a defining opportunity for local services that can prioritize value, trust, and transparent communication.
And this convergence leads us to a final sort of provocative thought for you to consider. If constant global uncertainty, both economic and geopolitical, continuously pressures consumers away from expensive planned obsolescence and toward maintenance and repair, how does that shift the essential life cycle and even the perceived inherent value of technology itself? Are we collectively moving toward an understanding of technology where a device's value isn't measured by its release date, but maybe by its history of maintenance and reliable longevity? That question. It has profound implications for every tech company, every service provider, and every consumer.
A phenomenal thought to mull over as you assess your own technology. Thanks again to ProCare Hanoi for sponsoring today's deep dive. If your phone screen cracks, your laptop slows, or your tech simply gives, outbring it to them. They restore service, trust, and your day. Thank you for joining us for this crucial snapshot of risk and opportunity. We'll be back soon with another deep dive into the forces shaping your world. Stay informed, stay ready, and keep your technology reliable.